Crypto markets drift back after an explosive rally as merge optimism takes a pause. Vol catches a bid ahead of FOMC and skew moves back to puts as short-dated calls get sold back. This week sees a large options expiry, which could pin markets into Friday without a major move on the Fed. All this and more in this week's Crypto Insight. Crypto this week, what have we got? Fourth wave still in progress, it seems. So we've got this kind of consolidating choppy price action in Bitcoin, managed to get as high as sort of 24K, has now pulled back again to about 21K. But, you know, nothing really in that price action to suggest it's anything other than a fourth wave. If we were to break violently below 18K, that would confirm the fourth wave was complete up there, and we're in the process of a fifth wave down towards our ultimate target of wherever that may be, which might be, you know, something like 12K or something like that. But if the fourth wave's not over, then you might get one final squeeze that gets you up to 28K or something like that. And that's where it fails. And then it ultimately heads out. And actually, gun to my head, I'd probably favor that scenario, right? So I think we might get some bearishness this week or whatever. Then we might have, you know, post expiry, we might get some more optimism around the merge. Crypto might have another go higher. We could maybe get as far as that 28K best case. And then we're probably going to fail there basically. And then the macro, as the macro backdrop worsens, you know, we may see that sell off with equities if equity does ever finally sell off. Okay, so that's kind of my thoughts there. Now, you know, I do think the Mt. Gox supply that's going to hit the market in August apparently is going to keep a bit of a lid on Bitcoin. So like I say, if we do get a crypto rally, I think it will be led by Ethereum still. That's where the catalyst is, right? And that's how crypto typically tends to behave, right? It kind of latches onto a catalyst and runs with that catalyst, right? And Bitcoin doesn't really have a catalyst right now in the short term, right? So and I think it'll be used as a funding leg. So people will want to buy Ethereum and fund it by selling Bitcoin to be beta neutral, right? And so if the broad crypto space sells off, they're kind of hedged. And if you get the outperformance of ETH that you think is possible, then you're doing okay, right? So you, rather than just buying beta to crypto, people are going to be looking more for alpha, and they'll do that via trying to get long ETH, short Bitcoin, I suspect. But yeah, from my opinion, until we get a clear break of 28K, the crypto winter is still here, despite what the temperature is outside. And then if we go to Ethereum, you know, threatened to have a little go, obviously had a beautiful bounce from 1,000 up to, you know, around 1,600, but looks to be giving some of that back. You know, quite an important level here around 1,400, which has just popped its head below, 1,395, 1,400. And then the next level below that is 1,270. If it can't hold 1,270, then it's probably just going straight back to 1,000, right? That's the truth, right? So kind of need this thing to really hold 1,270 to think that there may be legs for a final sort of ascent up towards here. If we do get sort of news around the merge that the market likes, ultimately, I could see a situation where this can go as high as maybe 2,500 best case, right? The literally blue sky scenario, right? I really don't see it getting above that. And even that is a stretch. Yeah. But I'm just trying to equate it to where the ETH Bitcoin spread is, right? So if you look at the ETH Bitcoin spread, where that is, that's kind of broken through this level, kind of needs to find support at this 0.664 level, 0.064 level. Yeah. It got as high as 0.0772. It's got resistance at 0.077. It's got a big one at 0.089. That would be a 32% outperformance of ETH from these levels, basically, right? Or maybe a little bit more now that we've sold off. Okay. So about 35% outperformance from here. So if by some miracle Bitcoin got to 28K, the equivalent level to be at that level in the spread would have ETH at 2,500, right? So I'm just trying to map out what the blue sky best case scenario to the upside that I see if things go well regarding the merge in the short term, right? And those are the kind of numbers that I'm kind of coming up with, right? That's not to say that's a forecast. It's just like trying to get a feel for where's the upside lie. And that's kind of what I've come up with basically, right? And for now, if you look at this spread, I mean, that's a very impulsive move higher. And really right now we're just chopping, right? This could well be the start of a real impulse move here, because we've got that leg higher, we've got consolidating price action. The next leg up could be the impulsive one that can take us into that area basically, right? But probably needs a catalyst. And the next catalyst is the final testnet merge on the 11th of August, I believe. So that will probably provide a bit more optimism into that or just after that. And usually I think these things will try to price it in a little bit early, right? So even though the merge date might be the 19th of September, people are going to be front running that, right? If they think this is happening and it's positive. So, by end of August, you're probably going to see, if you're going to see an up leg, you're probably going to see it by the end of August, I suspect, right? And then it may well get faded and it may well be a disappointment. One final thing to mention on ETH is that some of the layer twos have been getting traction, right? In terms of, scaling solutions and ways to process more transactions and stuff like that. So that's why Matic has been doing so well. Polygon, Matic, whatever you want to call it, has been doing very well recently, because people are now, innovating and actually putting things into the works ready for that merge, so they can then scale more transactions on Ethereum and stuff like that. Okay. And then lastly, if we want to look at what's going on in the alts, generally everything drifting lower. The AVAX, Sol, Algorand, Matic all getting a bit battered, 15% to 20%. Bitcoin, ETH down about 8% a piece. Just generally alts remaining with the super high beta, right? For now, alts are just the high beta version, right, of Ethereum essentially. That's what they seem to be. Like I say, I do expect another leg higher in Ethereum before this is done. And so that would probably be good for the alts. So, picking up some Solana in the low 30s might not be a bad idea. The vol's quite elevated there as well. So you might be able to sell puts if you've got the dry powder. Might be a way to look at it. What have I been doing in terms of my stuff? Well, I've had I put on some, for those who look at the vol dashboard products on crypto that I put out every Friday. I did do some Ethereum bullish riskies, 1,000, 2,400 bullish risky, and I hedged it with Bitcoin short futures. So that's my way of trying to get that spread on in a sensible way, taking advantage of the fact that I want some leverage to the upside in the explosion. And I think the skew can still go better bid for calls in Ethereum because it kind of touched neutral, but it's gone back towards puts. I think it's got room to reprice over the coming month, basically, right? So that's kind of how I'm playing it. Okay. Anyway, that's kind of it for the quick crypto summary. I'll hand over to Aaron and then I'll come back with the vol.
Week for on-chain, starting off as usual with Glassnode. The sort of theme for their analysis this week, it was looking at this recent move, kind of looking at some of the stuff we looked at over the past weeks, went back over it, trying to see, basically rationalize that this kind of pop we've seen lately was as expected. We saw it coming. There were some signs of seller exhaustion, things like that. That was what they kind of looked at the first half. The second half of the analysis, they looked to see, okay, where are we going from here? Do we have resistance to this relief rally, or are we ready to start significantly moving back up? And that takes us to this chart here in the top left, where we're looking at the on-chain cost basis for basically 4 different segments. So in the blue, you have the long-term holder cost basis, which is just cost basis. It's just the same thing as the realized price. And the realized price for the aggregate market is what you have here in orange. And then as you move up, you have the short-term holder cost basis right around there at 28,000. And then above that, you have the realized price to liveliness ratio. And so Glassnode uses this realized price to liveliness ratio as a way to quantify what they call a hodler fair value. And the way they do that is the liveliness is when you compare coin days created to coin days destroyed. And so they do that, if you recall, when a coin hits a new address, a new wallet, it'll start counting how many days those coins have been there since they moved last. And so they use liveliness to say what's going on in the market. Are more coins being created or destroyed? And then it compares that to the realized price. to create this ratio where the purple line is at, which is currently around 35.8 thousand. So, it's interesting. You could see you have the long-term holder cost basis and the realized price pretty much right here at the same spot around 22,000 where we've been trading. A little bit higher is that 28,000 mark where the short-term holder cost basis is, which is interesting because it kind of lines up with some of the analysis from Imran this week and last week. And then, but really right now, if we zoom in on what's going on here with the long-term holder and the realized price, that takes us to the chart in the top right. And so basically what this is showing is when you zoom in on the long-term holder realized price and the aggregate market realized price, you can see it's pretty rare in the history of Bitcoin for that long-term holder cost basis to move up above the realized price. So you can see it's happened 3 times. The blue goes above the orange in the, let's see, the 2012, 2013, which was a bear market, 2015, 2016 was a bear, and then that 2018, 2019. So it lines up all in bear markets, and that's where we're at right now. But the thing worth noting is that you could see once it moves down, it stays there for a decent amount of time, right? 248 days, 575, 288 days. And currently we've only been there for 17 days. So it would seem to show that we probably have a little more time where this long-term holder cost basis manages to be above the realized price. And you could see also here down here at the bottom, it kind of tells you how many days it took for price to see its absolute low once you did have that crossing long-term holder above realized price. So 68 days, 77 days. The outlier would be the first one where it only took 2 days, but it does kind of seem to tell you that we might have a little bit more of a grinding down and some sort of resistance or headwinds right above us as we kind of formulate this bottom. So moving on from there to the bottom left, we have the 140-day market realized gradient oscillator. And so really quick, what the market realized gradient oscillator tries to do is it tries to gauge momentum in the market by looking at the rate of change between realized price and market price. And it does this to try and see if it can point out the speculative money versus the organic capital inflows, with the idea being you can look at the rate of change between realized price and market price to gauge those organic inflows, right? If realized price is the actual cost basis the last time the coins moved on chain, then that would be a little bit more organic capital inflows versus if the market price is just moving at a quicker rate. And so what this basically shows you is that above 0, anything positive on this purple line here, that would be positive flows. That's a more rate of change in the realized price. Negative would be less constructive flows, more bearish inflows, where you're just getting outsized moves in market price. So basically what it's showing is that for the last 15 months, we've been in a pretty big macro downtrend ever since that early 2021 sell-off, where we've just had lower highs, having less constructive flows. And then on top of that, you could see in 2022, it's just been all negative. We haven't really had any good constructive positive flows, positive moves to the realized price. But you will know at the bottom of this trend, it has slowly been grinding higher. And we're starting to get to the point where the top of the trend and the bottom of the trend are meeting. So it does look constructive. It does look positive as we slowly move up. But it is showing that we could, again, similar to our chart here on the top right, we could have some headwinds to keep us in a little more negative territory for a little while longer. And that ties in right with our last chart, which is really looking at the supply dynamic. So the entity adjusted unspent realized price distribution is just a lot of words to say, these is the volume, the supply, the last time these coins were moved, right? So basically when you divide it up into short-term holder and long-term holder, the red and the blue, you could see there's a lot of short-term holders right where we're at now, around 20,000. A lot of short-term holders picked up coins around 30 and 40,000 as well. And this basically is just kind of showing that as we get a little bit more constructive price action, we start to move up. There is supply above us to where you might see some additional sell pressure. People at 30,000 waiting for break even, people at 40,000 waiting for break even. And that's also lines up with the short-term holder cost basis being up at 28K. That again, that could be supply waiting to be sold as people feel better about being break even and they get rid of the coins that have been underwater for a little while now. Moving on from there, we can take a look at Will Clement. Not a ton of on-chain stuff from Will this week. A lot of stuff that Glassnode covered, some stuff that we covered in the past, the capitulation tracker, which if you remember, it shows the MVRV, the market value to realized value, and also the SOPR, the spent output profit ratio. that's just realized and unrealized losses. Both of those are under 1. There wasn't really much of a change from when we featured it. But the thing I did think was very interesting is if you've been following Imran lately on Twitter, on some of his appearances, he's mentioned a couple of times, I think the first time I heard him say it was on Real Vision, where people are using Bitcoin and crypto as a inflation hedge, but in reality, it's more of a monetary debasement or monetary policy hedge. And Will Clement said pretty much the same exact thing in his newsletter. So I don't know if he follows Imran or he just came to the same conclusion, but he kind of said the same thing and had these charts that went along with it, which I found were interesting. So on the bottom left, you have the correlation between Bitcoin's price and the federal funds rate, and it's pretty much perfectly inverse, which makes sense. Interest rates, Fed funds rate goes up, it adversely affects risky assets, kind of like Bitcoin, so that makes sense. And then also on the flip side, you could see the positive correlation between Bitcoin's price and the M2 money supply. Again, that kind of falls in line with the conversation we've been having in the community in the Discord, where we're looking at the liquidity, just kind of showing that it might be some tight effects right now to the money supply, monetary policy, and risk assets, kind of like Bitcoin. And that is on chain for this week.
Okay, so looking at the vol stuff this week. So this is the kind of new look and feel of the GVol platform now. For those of you who have it or not, you'll kind of be aware there's an old version, a new version. This is a new version. So we've got the Bitcoin on the left, we've got Ethereum on the right. We can generally see the pink line, which is the 7-day realized, kind of rolling over on both. So whilst we had that explosive move, we then kind of reached a bit of a limit and we stabilized, it's drifted lower and realized it's kind of drifted with it. So Bitcoin's at about 70, just over 100 on Ethereum on realized. And you see the implied has kind of diverged away from that and held up better. So you've got an implied realized spread, positive spread there, right? And that's just because we're heading into FOMC, which is considered a market movement inducing event. So it makes sense for the implies to trade a bit elevated, basically, right? So that's as you would expect it. Also in general, with the explosive rally, we had a fair amount of speculative call buying come in. So you may have had a situation where some dealers are caught a bit short options and they're happy to bid them back, basically, right? So that's why there's a bit of a bid to that implied vol, okay? But I do expect a big vol crush similar to equities. I think we're going to get a big one post FOMC here as well. I'd expect the front end to get whacked, particularly Bitcoin. I think Ethereum might hold a stubborn bid to some extent at around 100 or 90 to 100 area, but you may see the front end of Bitcoin go back into the 60s, right? So you may get a contango come back into the curve post FOMC if Bitcoin net doesn't really go anywhere, right? And on top of that, when you have expiry at the end of this week, you might get fresh selling coming in to like replace calls that people have sold in July. They might want to sell more of them for August and stuff behind it. Okay, so that's kind of my thoughts there. If we look at the term structure, holding an inversion, as I've said, typically you don't hold inversions for so long, right? But this thing has done pretty well at holding an inversion, partly because obviously there's been a reasonable amount of realized lately, and we've got the FOMC. So you can see here, shadow IV is the last week's one, and the pink one is today. So pretty similar, right? It's barely moved. And then if you look at the time series of the constant maturity vols on the right-hand side, you can see that typically we have this kind of front end overshoots and goes below. Then the front end catches a bid. Then it overshoots and goes below. And it kind of oscillates around the long-term vol. That's what the short-term vol typically does. This time round into Friday, which is the 22nd, we saw the front end come down, but it didn't manage to get below the rest of the curve, which means the curve went from inverted to kind of flat, and now it popped back to inverted again. So it didn't manage to get into contango like it normally does. You can see that by the pink line not managing to cross over the other maturities, which are the other lines, basically. Same story on Ethereum. You can see the gap between the pink line and every other line is a bit bigger in Ethereum. Just means that the gamma in Ethereum's got even more premium attached to it because it's moving around like an animal, right? That's all it is. Okay, so that's the term structure and kind of what's been going on in that over the course of the week. Like I said, if you're going to go for the contango trade, you're going to go for the vol reset trade, it's a lot safer to do it in Bitcoin, because the problem with selling a load of gamma on ETH, whilst it's elevated, you may get random headlines coming out about the merge and stuff, and it suddenly shifts 10% out of nowhere, right? So probably taking on a lot more risk. In terms of the calendar, maybe that you might want to look at something, I wouldn't go too short dated because it just doesn't have any Vega on it. So I'd probably go something like August, maybe selling August and buying December in Bitcoin gives you that way, and you do it in a ratio. So you're short more August options and long less December options. Maybe you strike it to the upside as well, because you think in a rally, Bitcoin's going to get capped at like 28, 30K and then vol's going to get smashed. So maybe that's the way you structure it to play that vol reset potentially. Yeah. Okay. And then if we look at skew, I had said skew had kind of neutralized a bit on the back of all this kind of call buying and call flow that had come flying in last week, particularly on Ethereum. So you can see here, Ethereum on the right, Bitcoin on the left. You know, you got weekly skew to flat on Bitcoin, which is the pink one, but the rest of the maturities stayed firmly in put territory at -5, -7, around there. Whereas you look on Ethereum, the whole curve moved into call territory. So if it's gone above zero, it means the calls were trading at a premium for every maturity. And now they've all slid back in towards puts again. So as spot kind of rejected that 1670 area, it's come back down to break 1400. I mean, it's quite a hefty slide, right? It's sold off more than like 10 to 15% from the local high. So now puts are back in fashion, basically, right? People are buying puts again. So it's very spot sensitive, the skew in Ethereum right now. Because I'm slightly more bullish, like I don't think the merge catalyst is done. I think it's coming back and gives us some relative outperformance. I suspect we're going to get a call bid come back at some point, but that's just my gut, basically, right? You know, I could be wrong, but I certainly wouldn't be, you know, naked long. I'd be hedging it with Bitcoin, and that's why I'm doing, basically. Yeah. So that's skew. Now, if we look at the expiry, obviously, as I mentioned, there's an expiry this Friday. It's the July expiry. You can see here, we've got the open interest per expiry up here on Bitcoin and Ethereum. And you can see, you know, about 75,000 contracts, which is about 33% of total open interest expiring on Bitcoin. And you've got around 700K expiring in Ethereum, which is about 20% of total open interest, right? There's a hell of a lot. There's more. July was actually the biggest open interest month for Bitcoin, but the biggest one in Ethereum is December, right? We'll talk in a minute about why that is, right? But if you look at the kind of open interest landscape and where the strikes are, sort of in the local vicinity at around 20, 21K, it's quite uniform, right? So you can see here that you've got quite a uniform distribution of strikes there, okay, in terms of total open interest, right? Whereas if you look at the same thing on Ethereum, for this 1400 area, you've got this big peak, yeah? So it might be that, you know, the 1400 area in Ethereum acts a bit more sticky because there's more concentration around there, whereas it's a bit more uniform in Bitcoin. Remains to be seen, but just anecdotally, you know, we often see heading into a big expiry, the market does find a level where it wants to stick around, the expiry happens, and then it's freer to move. We may well see that again. If we do see that, then that would actually help the trades that fade. If you do any trades that fade the front end of the vol to try and play that collapse of the vol post FOMC, the expiry might actually be playing for you in that if it holds the market kind of around these sort of areas where it is, okay? All right, if we then go to the flows, before I go to the usual sort of block sniff, I want to show you guys a really cool chart from GVol called the gravity charts, right? These are new charts that they're going to release on their platform, courtesy of a guy called Fabio who works for them, who I interviewed, put out a YouTube video about it. It's a short one, so definitely suggest you watch it. But basically, these are gravity charts, right? And the idea of these charts is to try and kind of show you very quickly where the big flows are and and what direction. The most important part of these charts is the direction, right? Because the block sniffer tells you nothing about direction. It just tells you what traded in the big blocks, okay? This looks at real-time data for when the trade went up, compares the levels to where the screens are, and figures out what the aggressor was doing. Was the aggressor of that trade buying it or selling it, right? And you've had a very experienced market maker validate this to look at the logic that their algorithms are using to determine the direction. And he's helped them build this. So there's a decent edge in this basically. But apparently in the crypto market, like 30% of the trades are misreported from like buyers or sellers. So having something reliable that tells you if it's buyers or sellers is actually quite good. Okay. Anyway, so what we've got here is we've got the volumes. So we've got a number of contracts on the top charts, and we've got the weighted Vega. So this tells you the impact in terms of weighted Vega as well. So how meaningful are these trades for the option players, basically? Okay. And the conclusion really here is that in Bitcoin, you know, the biggest kind of icons, the biggest crosses or the biggest blobs, they signify the biggest volumes, basically, right? So you've got really the big ones are here. You've got December call flies that have traded, the 40K, 45K, 50K. That's these big crosses here. So they've gone up obviously in relatively large volume as a buyer of call flies. You've had a buyer of what looks to be a calendar here, where you've got July calls long versus short, some August calls. So there's a calendar here. And then you've got these, which are like March 23 call options being bought in the kind of 37 to 40 to 45K area, basically, right? So they look like just bullish outright call longs. So those are the flows that we've seen over the last week in Bitcoin, okay? And in Ethereum, again, you've got some really big flies going up again, 2,500, 30, 35 parked in December expiry. You've got some outright call spreads in these boxes, 20, what strike is it exactly? 2,600, 3,000 it looks like. So again, bullish structures parked in December seem to be the predominant flow that we're seeing. If you then have a look at what it means in weighted Vega, you'll see a slightly different picture, which will show you that all that stuff in December, it doesn't really have that much Vega impact. It might be really large in notional terms, in contract terms, but the Vega impact is actually not as big. Whereas you've got some other trades like here, a buyer of some September upside, which is a decent lump in terms of weighted Vega. You've got the March 23 calls being bought, which is a lump of Vega because they're outright options. They're not spreads, remember. So those are bigger clips of Vega. You've got a sell here in the kind of closer to the money stuff, which got a lump of deck Vega on it. And then you've got all this weighted Vega in the front end, right? Which makes sense because as you go to 1 week stuff, the weighted Vega goes exponential basically on 1 week stuff because the way the weighting is calculated. But basically, I would probably ignore that because it's all just 1 week optionality. It's not really Vega, even though it shows up as weighted Vega. So yeah, actually, I would ignore the July stuff, right? But basically, just kind of the difference between this and this in the long end kind of shows you where the Vega lumps basically sit, and where the buying is going on and where the selling is going on, right? So that I think that's quite a useful kind of graphic. Yeah. Moving back to our usual block sniffer, where I actually highlight it here. As I said, you know, in Bitcoin, really the predominant flows are March calls being bought, debt call flies being bought. You've got 74% for the call volume there versus puts. The short dated stuff in July, you can see here, is generally DOV hedging, but you did also see July 25 calls that were rolled into August. Okay, so you see that there. Well, actually, no, the other way around. Sorry, we saw buying of the Julys and selling of the August. So that's a roll of a short, basically, right? Which we saw on the gravity chart. And then here we've got massive volume in call flies to December in Ethereum, 70,000 lots. So that's nearly $200 million notional of those call flies that have gone up, which sounds enormous. However, if you look at it in premium terms, it's less than $2 million of premium, right? And it's just a very highly leveraged bet that the market goes to 3,000 for December. If the market goes to 3,000 for December, the person who's done that fly, if they close their eyes and do nothing and it goes to 3,000, they make 20 times their money. So 2 million turns into 40 million, basically, right? I don't think that's how they're going to manage it, to be honest, because that would be a bit insane. Yeah. But if they made 3 or 4 times their money, they'll probably take it, to be honest. Yeah. And then if we look at the other stuff going on, selling of July call spreads and selling of August calls, getting some premium back from the elevated vols in the front end. That's what we're seeing there. But you can see the sizing of those bars relative to what's going on in December. You just can't compare it basically, right? Because that's completely swamping the flow. Yeah. Anyway, that's it from me on crypto flows this week. Call it a day. Over to you lot. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.